Larry Summers there. Karissa McDonough joining us right now, fixed income strategist over at Community Bank Trust Services. Karissa, let's just start off. Are you also scratching your head over what happened on Wednesday?
Well, not so much scratching my head. I actually think that Larry Summers had a great point. I think this had everything to do with politics. I was actually expecting to see kind of a divided vote in terms of the policy action, but they were unanimous. And I think the way that Powell managed to thread the needle and get the unanimous vote was you have this very strong half-a-point hike priced in or jawbone through the end of the year, where the market barely expects possibly one more hike by July, if that. So yes, he did an effective job of threading the needle. He really doesn't want bond investors to price out any more hikes. That inverted yield curve is kind of doing the Fed's job for it in terms of choking off credit creation. So this was very purposeful.
What are you seeing, though, in the fixed income space? We talk about the equity market kind of shrugging it off. I know the equity market is down today, but still 5 straight weeks of gains for the S&P, fresh 52-week highs, and yet I'm looking at a bond market that seems to be pricing in a lot less optimism.
Yeah, well, I think what the bond market is saying is that, yes, we expect this type of jawboning exercise out of the Fed. The bond market right now is pricing in maybe one more hike, possibly, but I think the bond market is telling us, again, along the lines of what Scarlett had also said previously, that this is pretty much it. If you do look back at history, every other hiking cycle that the Fed has paused, that's been it. They do not go back, and I think part of the reason for it, that pause allows the economic data to catch up so that the next time you actually have a live meeting, the data catches up and the Fed no longer needs to take action. Like inflation has actually slowed sufficiently. And I think that's probably what we're going to see here.
Yeah, but I suppose, he wants to keep the door open because just in case this time could be different. Karissa, one thing you pointed out in your notes that you think investors should be mindful of is Powell's comments on commercial real estate and specifically losses from commercial real estate and how they are well distributed and not systemic. You say that that's a contradiction.
Yes, that's an excellent point. Powell was asked during the press conference about the banking stress, especially the banking stress that we had seen in March, and which led to several failures. He said that he doesn't think it was going to be systemic because such losses are well distributed. We actually think that's a contradiction. If something is well distributed, that by its nature is a systemic risk, and the systemic risk is directly predicated on that inverted curve. As long as banks are having to chase deposits at over 5%, and their balance sheets are weakening because of loan losses in their real estate portfolios. Banks are in a uniquely difficult position, and that is somewhat concerning, and that's something I know the Fed is looking at, even if they don't want to telegraph such things. So.
And I'm glad you bring up the inverted yield curve. We see the 2s, 10s inverted for almost a full year now. Which part of the yield curve do you find more useful? 2s, 10s, 3-month, 10-year in understanding and prognosticating what could happen next?
Well, excellent question. I think all of it is useful. What we've seen, though, historically speaking, is that 3-month, 10-year has a 100% correct track record when you look back to the 60s in terms of telling us whether or not there's going to be a recession. It's kind of an 8 for 8. It's been right every time. And the interesting thing is the magnitude of the inversion we're seeing right now is unprecedented. We haven't seen it this inverted in any cycle. So for me to tell you what's going to happen based on the magnitude of the inversion, I don't know. There's no historical precedent, but I do know that there's likely a recession coming within the next 12 months.
On that point, though, Karissa, I mean, when you talk about the magnitude of that inversion, there's also been a lot of debate here about the length of the inversion and how that in and of itself is also unprecedented. And I'm wondering, does that sort of muddy the picture of just how much of a signal or just how much of a forecasting tool this really is?
I don't think so. There's a pretty good, correlation, say, between the length of the inversion and then the length of the possible pending recession. I don't think that there's any problem deriving the fact that there will be some type of recession. In general, if an inversion lasts however many months, that's kind of how long the recession is going to last based on historical data. So we would expect to see a recession, in the neighborhood of 11 to 12 months, at least at this point. That's how long that's been going on for. So, yeah.
All right, yeah, just looking at that right now. I mean, we're basically a negative 140 basis points right now here. Chris, you're going to have to leave it there. Have a wonderful weekend. We'll catch up with you soon again, I'm sure. Karissa McDonough over at Community Bank Trust Services helping us count you down to these closing bells. A lot more coverage coming up.